Monte Carlo Rendezvous de Septembre has been a great talking place for a number of issues. We're here to discuss what has been coming up over the last few days here in Monaco. I'm Yvette Essen for AM Best TV, and I'm joined by a panel of AM Best analysts who've been engaged in discussions with brokers, insurers, reinsurers, consultants, a wide variety of people across the industry. We have Stefan Holzberger. Stefan is the Chief Rating Officer for AM Best. Bob DeRose is the Senior Director for Global Reinsurance. And Tony Diodato is the Managing Director of Analytics. Thank you for joining me. We've obviously had a lot to talk about the last few days. Perhaps I could ask you to each summarise something that stood out for you, starting with Stefan.
Sure. I think for me, one of the main themes of the conference has been the convergence between traditional reinsurance platforms and groups and the convergence capacity, non-traditional capital. You saw a tie-up between Markel and Nephila announced, also Apollo and Aspen, and I think what you're seeing is the benefit from both sides of that equation, that bringing those forms of risk transfer together in a larger organization really adds to the diversification and the optionality for these organizations to match the risk taker with the risk cedant.
Bob, for you, what stood out?
Yeah, I think that everybody is trying to anticipate what the January renewal season will ultimately end up looking like. As we know, following the events of 2017, the renewal periods both in January and June proved to be somewhat disappointing. And I guess questions really around what the trend means going forward. Now we have another wild card. Florence is out there in the mid-Atlantic and threatening to hit North Carolina. And it looks like it could be a meaningful event. So questions are, is it going to be significant enough to cause any type of change? Or will the renewal season, be flat? And really, I guess some concerns possibly could it go down. I think that that's probably relatively remote. And then alternative capital and what role that may play not only in these upcoming events, but how that will play out over the longer term.
Tony, what has grabbed your attention these last few days?
Well, as my two colleagues have said, they used the word change, and it's change not only in the capital structure of the industry and what is coming together, but change from a technology point of view. We often talk about innovation, and innovation is not just the new product, but how do you become more efficient in the way you acquire business, the way you process business, because that's going to be a deciding factor for many companies. Are you able to distinguish yourself not only on price, but more efficient in the process to gather business and to process it?
Bob, you're nodding there. Innovation's obviously come up a lot on your agenda and the topics of conversations.
Yeah, I mean, Tony's saying it, and really what it comes down to, everybody wants to try to find ways to get closer to the customer, closer to the risk, and innovation is certainly a very, very integral piece in order to accomplish that. So whether you're a reinsurer, a broker, or an insurer, you're trying to find ways to basically capture the client, ways to basically guarantee that that type of risk, that type of business will be there for the long term. And innovation's, the leading edge of that.
M&A activity obviously has also been brought up here a lot. Bob, can you explain to me what you've been hearing with regards to M&A activity?
Well, M&A is always a hot topic at any rendezvous. Obviously, there have been some very recent transactions. Stefan mentioned the Nephila Markel transaction and then the Apollo Aspen. I guess there are two recent examples, somewhat unique in that it's an amalgamation of alternative and traditional capital coming together. In the more distant past, Excel and AXA, two traditional players finding ways to basically improve their relevance to the market. So I think that there's questions going forward, where will M&A go? I think anytime there's a lot of pressure on market terms and conditions, M&A is one of the logical choices or conduits to make to basically make the propensity of your business better going forward. There's speculation as to who may be next. I don't think anybody knows the answer to that, but obviously we do think that M&A will continue.
The one point on that with the M&A, what we see is more strategic acquisitions, and what we don't see, or we haven't seen up to this point, is just a me too. My competitor made an acquisition, they're bigger, I've got to follow them. So at this point, it seems to be very structured and very refined, that if I'm going to make an acquisition, it has to be something that's going to be accretive to our earnings and to make us a better organization going forward.
Yeah, maybe just to add to that, we've been talking about this for several years now, and when you see how successful the top-tier reinsurers have been, even in difficult underwriting years, 2017 with the catastrophes, we really saw the pressure on property and casualty on the non-life book of business. And the top-tier reinsurers, they've had that diversification in the life and the health sector, which has really supported earnings during difficult years. So with M&A, which we really do think is going to continue, it's really all about that diversification, the size and the scale, the ability to kind of tap into the alternative capital markets, as well as other segments of the insurance industry to benefit from a diversified source of earnings.
One key point with the acquisitions, the blending of the cultures is very important. And you could have two very well-run organizations trying to come together, but if there's not a cultural match there, that is going to struggle to get the efficiencies they need out of the merger.
Obviously, terms and conditions must be discussed here. Monte Carlo, the Rendezvous de Septembre, is seen as the starting point for negotiations for the January 1st renewal period. What's the feeling, what's the sense of where terms and conditions are going this year? Starting with Tony, perhaps.
What we've heard, into flashback to last year, at this time there were significant events that either happened or were in the process of happening. And as those developed through the latter part of 2017, there was great anticipation that there was going to be a hard market. The return was coming and we're going to get the bang for the buck that we had in prior years. And as Bob said earlier, it fizzled out as each renewal period came through. So now as we fast forward to 2018, Hurricane Florence is out there. There have been still wildfires burning in the U.S. You have some other storms of Helene and Isaac out in the Atlantic, still churning. The sense is that after the full start of 2018, there's not great anticipation that you're going to have a big hard market. In stabilization, some of the key areas where there has been impacted areas, you're going to see increases, but it's not going to be the good old days where you're going to have substantial earnings and rate increases.
Yeah, I echo all of those sentiments, and I think that really what we can hope for is that there's a stabilization in terms of pricing through the January renewal. I think Florence is somewhat of a wild card, but assuming that that event is absorbable by the capacity of the market, and I anticipate that it would be flat to slightly improvement, but I think most people are anticipating just a flat renewal. And when you think about where returns have been, and no matter what metric you want to use to measure that, combined ratio or ROE, I think everybody acknowledges that certainly for the traditional players, we're at the bottom. We really can't go any lower. And hopefully that's going to serve as a basis for not only the reinsurers and the brokers, but also the clients to understand that really pricing has to stabilize. We really can't afford to move any lower than we already are.
And part of the reason, after the significant events of 2017, capacity hasn't shrunk, and it's gotten stronger. It was an earnings hit for most companies, and it's not something where they had to reload capital. Some of the collateral markets had to, but the major players, they had a blip in their earnings. They didn't have to go raise capital, so they absorbed it. And if there's not a diminishing of capital, you're not going to have those major increases, and that's why you're just seeing incremental increases and nothing major coming through.
Over the last few days, you've met lots of different types of companies. Bob, maybe you can tell me about some of the key concerns of companies at the moment.
Well, I think we've kind of touched on them. I mean, I think that obviously for reinsurers, they're trying to enter the negotiations for the January renewals on an upbeat note, trying to make sure that their clients understand their return hurdles and that the pricing has to start to try to improve, not only at the reinsurance level, but at the primary level as well, because a lot of primary companies would acknowledge that for certain casualty classes of business, there just isn't the price adequacy in those classes of business that there needs to be. So I think that that we're here to start the negotiations, as you alluded to, and I think that reinsurers are trying to step off in a positive way and enter the renewal period on a note that at least talks to stabilization and not further deterioration.
I think on the property side, which tends to get a lot of attention, we have reached a floor in terms of where pricing is going to play out over the next renewal cycles. ILS funds and the alternative capital providers in some cases have actually pulled back some capacity, recognizing that the returns on an expected return basis really just aren't where they were a few years ago, and it just makes the asset class a little bit less appealing. And Bob talked about on the casualty side, for the longest time, as we know, the property returns were supporting fairly weak returns on the casualty side. So I think there's a broad recognition in the market that casualty rates in particular classes also have to go up.
So from our discussions with companies, I'm sure they've been asking us things that they want to know. Stefan, what have they been asking you from a ratings perspective? What do companies want to know from us?
Right. Well, it's been almost a year since we released a significant update to our global rating methodology for insurance companies. And I think over the past, say, 8 or 9, 10 months, it's really been a process for companies to get some familiarity, get to understand the drivers of our kind of building block assessments, whether it's balance sheet strength, operating performance, business profile, or ERM. And it's really not just an understanding of how that rating analysis under the new methodology fits for their organization, but kind of how are we looking at their peer companies, right? Because that's always a big area of interest. You're scoring me this way for balance sheet strength, but what about the companies that I compete with on a day-to-day basis? Are you scoring them the same as me? Are they coming out stronger? If so, why? And those sorts of questions have been on the forefront of our rated clients' minds.
And those are things that, as Stefan said, we've talked about with our companies here. It's something that we're also working on, putting some criteria pieces together and benchmarking that will release later in the year to illustrate and demonstrate what those companies look like. If you're getting a +1 in a category, who are the other common companies in there? Those things will be coming later in the year.
Yeah, I think the way to summarize it is every company wants to be best in class, and they want to be best in class across the entire rating spectrum. So if a company if one of their peers is scored higher, they want to understand, well, why is that peer scored higher, and what do we have to do in order to earn that for ourselves?
Before we came out here to Monte Carlo, we published our global reinsurance report and we published our outlook for the sector, which was again negative. Bob, Teddy, being out here, how has that reinforced, if it has reinforced, our opinion on the outlook for the reinsurance market?
Yeah, well, again, it really, as everybody knows, all reinsurers are very, very well capitalized and certainly have the capacity to absorb adversity, certainly over the near term. What really is dictating our outlook is the operating and total performance of the sector, which really has been under pressure for a number of years. In order to attain and retain investors, you have to provide a reasonable return, and you need to have strong financial flexibility, which comes from the investors. So our concern has been and continues to be on profitability and improving that profitability. And I think once we become comfortable with where that's going to play out, and also looking at the cost of capital, taking that into consideration, and organizations are working on ways to improve their efficiency, to reduce their cost of capital. If those things align, then possibly at some point in the future we may find our way to revise it to stable, but I still think it's somewhat out in the distance.
Yeah, I think it's important also to focus on some of the positives. Coming from the rating agencies, we don't want to be just negative. We do have a negative outlook. It's been on the sector for several years now, but there are some signs of positive aspects to the market. We see a slow rise in interest rates, which will be a positive on investment income, helping that bottom line. Economic growth in some of the mature Western markets has driven an increase in the underlying demand for insurance, and on a quota share treaty and things of that nature, the reinsurance sector is benefiting from that as well. Plus the significant cat events from last year, those have led to an increased demand for reinsurance. So there are some opportunities, cyber, mortgage, other opportunities out there. So I think we're kind of balancing a very difficult pricing environment, suppressed returns because of how much excess capacity remains out there, as Tony said. But at the end of the day, there really are some good opportunities for reinsurers, and we do see them taking advantage to some degree.
The reinsurance segment in companies have been very resilient over the years. They've been through many different challenges. This is just another one. We see them coming through, but a point that we've all said is How are you innovating the way you do business? How are you squeezing out more profitability and reducing your cost? Innovation is very important, not only from seeing the company, but AM Best, where we already put a survey out this year. We're going to have further discussions with companies about innovation. We're going to build it in part of our criteria. So it's such a key component to distinguish yourself in the future as an organization. If it's reinsurance or commercial, wherever you are, you have to do that. And we see it as a very important component in the future. We'll have more to come later on in the year.
Stefan, Bob, Tony, thank you for summarising all those points and all those talking points in a short time. For AM Best TV and Monte Carlo, I'm Yvette Essen.